What happened in the first quarter of this year represents the largest coordinated sell-off of United States Treasury bonds in recorded history, and the implications are so profound that every major government on Earth is currently recalculating their entire economic strategy while finding no comfortable answer. In the span of just 90 days, 3 countries executed a financial maneuver that mainstream economists had dismissed as economically impossible and strategically unthinkable. China, Japan, and Saudi Arabia collectively liquidated $800 billion in US Treasury holdings. And this is not a temporary adjustment or portfolio rebalancing. This is a structural shift that changes everything about how the global financial system operates. What you are about to hear is not being reported accurately in mainstream financial media, and there is a reason for that. The full implications of this development threaten the foundational assumption that has underwritten American economic dominance for 80 years. Let me take you inside every dimension of this moment. How did 3 countries execute the largest Treasury sell-off in history without triggering immediate dollar collapse? What does this mean for the Federal Reserve's ability to manage interest rates and fund government operations? And what does a world without dollar dominance actually look like for ordinary Americans? There are 3 questions that will drive everything that follows. First, what are the actual numbers, and what do they tell us about coordinated strategy versus independent decisions? Second, why is this happening now after decades of accumulation, and what structural forces are making dollar holdings untenable? Third, what are the cascade effects that follow from this initial shock? And what does the timeline look like for fundamental system transformation? By the end of this analysis, you will understand why the global financial architecture is shifting in a way that has no modern precedent and no established playbook for American policymakers. Section 1, the numbers and what they mean. Let me start with the raw data because the numbers themselves tell a story that most analysts are either missing or deliberately avoiding. In the first quarter of this year, China reduced its US Treasury holdings by $280 billion. Japan liquidated $360 billion. Saudi Arabia sold $160 billion. The combined total of $800 billion represents approximately 11% of total foreign holdings of US government debt executed in a single quarter. To understand the magnitude, consider this context. The previous record for quarterly foreign treasury sales was $120 billion during the 2008 financial crisis, when countries desperately needed dollar liquidity to stabilize their banking systems. This current sell-off is nearly 7 times larger, and it is occurring during a period of relative financial stability with no immediate liquidity crisis forcing the action. Here is what you need to understand about Treasury market mechanics. When foreign countries sell massive quantities of US bonds, they are exchanging those bonds for dollars, then converting those dollars into other currencies or assets. This process puts downward pressure on bond prices and upward pressure on yields. Higher yields mean higher borrowing costs for the US government. Every 1% increase in Treasury yields adds approximately $300 billion to annual government interest payments. The Federal Reserve has been trying to manage interest rates higher to combat inflation while simultaneously managing them lower to reduce government borrowing costs. This is an impossible contradiction, and the only reason it has been manageable is that foreign central banks have been willing to absorb new Treasury issuance. When the largest foreign holders simultaneously become net sellers rather than buyers, the Fed loses its ability to maintain this contradiction. But the numbers reveal something even more significant than market mechanics. Look at the timeline correlation. China began accelerating sales in November of last year, immediately following the Treasury Department's announcement of sanctions targeting Chinese financial institutions. Japan's sales accelerated in January after the Bank of Japan finally abandoned yield curve control and allowed rates to rise. Saudi Arabia's sales spiked in February following the BRICS summit, where discussions of alternative payment systems dominated the agenda. This is not three independent decisions. This is coordinated de-dollarization strategy being executed with careful attention to timing and sequencing to avoid triggering the very dollar collapse that would destroy the value of remaining holdings. Game theory explains this perfectly. Each country wants to exit dollar assets before the system breaks, but exiting too quickly or too obviously would accelerate the break. The solution is coordinated gradual exit that maintains plausible deniability while systematically reducing exposure. The composition of what they are buying with the proceeds tells you everything about their strategic assessment. China is converting dollars into gold, commodities, and strategic resource stockpiles. Japan is repatriating capital to defend the yen and rebuild domestic manufacturing capacity. Saudi Arabia is purchasing Chinese and European infrastructure, energy assets, and diversifying into euro and yuan-denominated instruments. None of them are simply rotating into other dollar-denominated assets. They are exiting the dollar system itself. Owakastar and Dean trades in the Anjin Towandi Owanti Anti Anti Anzi Anzinti Owanjinti Anzi Teen Section 2. Why this is happening now? Now that we understand the scale and coordination of the sell-off, we need to examine why this is happening now after 80 years of dollar accumulation. The answer requires understanding three simultaneous structural shifts that have made dollar holdings transform from strategic asset to strategic liability. The first structural shift is the weaponization of dollar access as foreign policy tool. The United States has used SWIFT sanctions, asset freezes, and treasury sanctions with increasing frequency and decreasing selectivity. Russia's dollar reserves were frozen in 2022. Afghanistan's reserves were seized. Iranian institutions are locked out of dollar clearing systems. Chinese banks face secondary sanctions for doing business with sanctioned entities. Every country watching this understands a simple truth. Dollar holdings are not actually your assets if another government can freeze or confiscate them based on political disagreements. The reserve currency is supposed to be a neutral store of value. When it becomes a weapon, it stops being a reserve currency. This is not speculation, this is game theory. If your reserves can be frozen, they are not reserves, they are hostages. The second structural shift is the interest rate environment and its sustainability. For 15 years after 2008, interest rates were effectively zero. Countries holding treasuries were earning nothing, but they accepted this because dollar liquidity and transaction utility provided other benefits. Now, rates are above 5%, but this creates an impossible fiscal trap for the United States government. Let me explain the arithmetic. The US government currently carries $34 trillion in debt. At 5% interest rates, that is $1.7 trillion in annual interest payments. This is more than the defense budget. This is more than Social Security. This is approaching 25% of total federal revenue going purely to interest payments. This level is structurally unsustainable without either massive tax increases or spending cuts that are politically impossible. The Federal Reserve cannot keep rates high without triggering sovereign debt crisis. But it cannot lower rates without reigniting inflation that is already destroying purchasing power. This is the trap. And every central bank holding treasuries understands that the only way out of this trap is inflation that destroys the real value of the debt. If you are holding the debt that will be inflated away, you have powerful incentive to exit before the inflation acceleration begins. The third structural shift is the emergence of alternative transaction systems that eliminate the need for dollar intermediation. The BRICS payment system is now operational for bilateral trade between member countries. China and Saudi Arabia are settling oil transactions in yuan. The European Union is developing euro-denominated energy contracts. Cross-border payment systems using central bank digital currencies are being tested across Asia. These alternatives are not theoretical anymore. They are functioning systems processing real transactions. The dollar's dominance was never based purely on trust or habit. It was based on necessity. If you wanted to buy oil, you needed dollars. If you wanted to clear international transactions, you needed access to dollar banking systems. When that necessity dissolves, the accumulated dollar holdings become unnecessary inventory rather than required reserves. Section 3, Historical Pattern Recognition. What we are witnessing is not unprecedented. It is the terminal phase of reserve currency transition, and history provides clear pattern for how this process unfolds. The transition from British pound to US dollar as global reserve currency offers the most relevant template, and the parallels are disturbing for anyone invested in dollar stability. In 1914, the British pound sterling was the undisputed global reserve currency, backing approximately 60% of international transactions and reserves. Britain ran the world's largest empire, controlled global trade routes, and London was the undisputed financial capital of the world. By 1945, the pound had lost reserve status. Britain was bankrupt, and the empire was beginning its rapid dissolution. The transition did not happen in a single dramatic collapse. It happened through accumulating structural pressures that made pound holdings untenable. Britain financed 2 world wars by printing currency and running massive fiscal deficits. Inflation destroyed purchasing power. Countries holding pound reserves watched the real value decline year after year. The breaking point came when Britain could no longer maintain gold convertibility and was forced to devalue in 1949. The pattern is this: reserve currency status creates the ability to run persistent deficits because other countries need your currency and will finance your spending. This creates moral hazard where fiscal discipline disappears. The deficits accumulate into unsustainable debt levels. Inflation becomes the only politically feasible solution. Inflation destroys the store of value function that makes a reserve currency viable. Foreign holders exit. The exit accelerates the decline. The currency loses reserve status. The United States is in the middle phase of this pattern. The deficits are structural and growing. The debt levels are unprecedented in peacetime. The political system is completely incapable of fiscal discipline. Every budget negotiation ends in continued deficit expansion. The only question is whether the exit happens gradually over decades like the pound transition, or whether some catalyst triggers rapid acceleration. But there is a critical difference between the pound transition and potential dollar transition. When the pound collapsed, there was a clear alternative ready to assume reserve status. The United States had the world's largest economy, largest gold reserves, and political stability after the war. The transition was orderly because the replacement was obvious. Today, there is no single obvious replacement. The euro has its own structural problems with fiscal fragmentation. The yuan is not freely convertible, and China maintains capital controls. Gold cannot scale to handle modern transaction volumes. This means the transition will not be from dollar to alternative reserve currency. It will be from single reserve currency system to multipolar system with regional currencies and commodity-backed settlement mechanisms. History shows that transitions between monetary regimes are chaotic and destructive. The collapse of the Bretton Woods gold standard in 1971 triggered a decade of stagflation. The Asian financial crisis in 1997 destroyed currencies and governments across the region. The absence of clear replacement for the dollar means the transition will be even more volatile. Section 4, the cascading implications. Understanding the historical pattern helps us map the cascade effects that follow from this initial $800 billion sell-off. These effects operate on multiple timescales simultaneously, from immediate market impacts to multi-decade structural transformations. The immediate effect is pressure on Treasury yields and government borrowing costs. As foreign demand declines, the Federal Reserve faces an impossible choice. It can allow yields to rise, which triggers debt crisis as interest payments explode. Or it can intervene to suppress yields through money printing, which accelerates inflation and confirms to foreign holders that exit is necessary. This creates a doom loop. Foreign sales push yields higher. Higher yields force Fed intervention. Fed intervention creates inflation. Inflation accelerates foreign exit. The cycle reinforces itself until something breaks. The breaking point could be loss of confidence in Fed's inflation control credibility, or political crisis as interest payments consume the budget, or currency crisis as inflation expectations de-anchor. The second order effect is the transformation of global trade architecture. For 70 years, international trade has been denominated in dollars, regardless of which countries were actually trading. A Brazilian company selling soybeans to China would invoice in dollars, execute payment in dollars, and hold working capital in dollars. This created persistent dollar demand independent of actual trade with the United States. As dollar holdings become liabilities rather than assets, this system transforms. China is already settling approximately 30% of its trade in yuan. The percentage is accelerating. Russia is settling virtually all non-Western trade in rubles, yuan, or commodities. The BRICS nations are creating bilateral payment mechanisms that bypass dollar clearing entirely. This transition eliminates a structural source of dollar demand worth trillions annually. When trade no longer requires dollar intermediation, countries need smaller dollar reserves. Smaller required reserves mean more selling pressure on existing holdings. This is another reinforcing cycle that accelerates once it begins. The third order effect is the potential collapse of the petrodollar system. Since 1974, Saudi Arabia has agreed to price oil exclusively in dollars in exchange for US military protection. This deal created structural dollar demand because every country importing oil needed dollar reserves. The petrodollar system has been the foundation of dollar dominance for 50 years. Saudi Arabia selling $160 billion in treasuries while simultaneously negotiating yuan-denominated oil contracts with China signals the end of this arrangement. The Saudis are diversifying away from dollar dependence because they no longer trust American security commitments, and they see the economic writing on the wall. When oil trades in multiple currencies, the structural demand for dollars collapses. Let me explain what this means in practice. Oil currently trades at approximately $80 per barrel. Global consumption is roughly 100 million barrels per day. That is $8 billion of dollar-denominated transactions every single day, or roughly $3 trillion annually. If even 30% of oil trade shifts to yuan, euros, or other currencies, that eliminates $900 billion of annual dollar demand. This is larger than the $800 billion sell-off we are analyzing, but on an annual recurring basis. The fourth order effect is the transformation of American fiscal capacity. The United States has been able to run trillion-dollar deficits because foreign central banks purchase the resulting debt at artificially low interest rates. When foreign demand disappears, domestic demand must absorb all new issuance plus refinancing of existing debt as it matures. The arithmetic is brutal. The US government needs to issue approximately $2 trillion in new debt this year to cover the deficit. It also needs to refinance approximately $7 trillion in maturing bonds. That is $9 trillion in total issuance that must be absorbed by the market. Domestic investors, pension funds, and banks have limited capacity. The Federal Reserve can print money to buy treasuries, but this is direct monetization that triggers inflation expectations. The political implications are profound. Every government program, every tax cut, every military expenditure has been premised on unlimited, cheap financing. When that financing disappears, the political system faces choices it has avoided for decades. Cut Social Security, cut defense spending, raise taxes dramatically. Every option is politically toxic, which means political paralysis until crisis forces action. Section 5, Scenario Development and Predictions. Let me outline 3 scenarios for how this plays out over the next 12 to 24 months, with probability assessments based on structural analysis rather than speculation. Scenario 1 is managed decline, where the Fed intervenes to prevent disorderly collapse, but accepts higher inflation as the price of maintaining system stability. Probability 40%. In this scenario, Treasury yields rise to 6 to 7%. The Fed pivots to yield curve control to prevent debt crisis, and inflation accelerates to 8 to 10% annually. Foreign holders continue gradual exit but coordinate to avoid triggering panic. The dollar declines 20 to 30% against major currencies over 2 years. This is painful but survivable. Scenario 2 is crisis acceleration, where some catalyst triggers rapid foreign exodus and the doom loop accelerates beyond Fed's control capacity. Probability 35%. Potential catalysts include major geopolitical crisis, loss of petrodollar system, or domestic political breakdown. In this scenario, yields spike above 10%. The Fed is forced to choose between hyperinflation through money printing or sovereign default. The dollar collapses 50% or more within months. This scenario leads to genuine economic crisis with depression-level unemployment and social instability. Scenario 3 is muddle through, where the current slow-motion transition continues for years without acute crisis. Probability 25%. The Fed manages to balance competing pressures, foreign exit proceeds gradually, alternative systems develop in parallel, and the transition unfolds over a decade rather than months. The dollar slowly loses reserve status but maintains regional dominance. This is the best case scenario, but requires significant political competence and international cooperation that current conditions make unlikely. Let me be specific about timeline and predictions. I assess 75% probability that within 12 months, foreign treasury holdings will decline by an additional $400 to $600 billion. I assess 60% probability that treasury yields will exceed 6% within 18 months, regardless of Fed policy. I assess 50% probability that oil will begin pricing in multiple currencies within 24 months, eliminating the petrodollar system. These are not prophecies. These are structural assessments based on game theory, historical pattern analysis, and incentive structures. The forces driving de-dollarization are structural, not based on individual decisions or policy choices. Even if every decision maker wanted to maintain the current system, the structural contradictions make it unsustainable. Closing synthesis. What we have examined tonight is the beginning of the most significant transformation in the global financial system since Bretton Woods collapsed in 1971. The $800 billion treasury sell-off by China, Japan, and Saudi Arabia is not an isolated event. It is the visible symptom of structural forces that have been building for years and are now reaching critical threshold. The analysis we have conducted shows how the weaponization of dollar access, unsustainable fiscal trajectory, and emergence of alternative systems have transformed dollar holdings from strategic asset to strategic liability. Game theory explains why coordinated exit is rational even if individual countries would prefer system stability. Historical pattern recognition shows this is the terminal phase of reserve currency transition, following the same pattern that destroyed pound sterling dominance. The cascade effects from this initial sell-off create reinforcing cycles that accelerate the transition regardless of policy response. Higher yields force Fed intervention. Fed intervention creates inflation. Inflation accelerates foreign exit. Exit eliminates structural dollar demand from trade and oil markets. Declining demand reduces fiscal capacity precisely when political system needs expanded capacity to manage transition. This is not prophecy. This is structural analysis of forces that are already in motion and cannot be reversed through policy adjustment or political will. The question is not whether the dollar-dominated system transforms, but whether the transformation is managed gradually or triggers acute crisis. I might be wrong about timeline or specific catalysts. The scenarios outlined involve uncertainty, and the structural analysis could miss variables that alter outcomes. If the predictions fail to materialize, we will examine why and what countervailing forces prove stronger than the structural pressures identified. The analytical framework itself remains sound regardless of whether specific predictions prove accurate. What matters most is not accepting any analysis without critical examination. Question the evidence presented here. Test the framework against developments you observe. Examine whether the cascade effects materialize as predicted. The goal is not to convince you of specific conclusions, but to provide analytical tools for understanding structural forces shaping global events. This is not the end of the story. This is the beginning of the transition that will define the next decade of global economic and political developments. We will continue to track foreign treasury holdings, monitor alternative payment system development, and analyze policy responses as they emerge. The structural forces we have examined will continue to operate, and their effects will become increasingly visible as the transition accelerates. The $800 billion question is not whether the system is changing. The system is changing. The question is whether we understand the forces driving that change clearly enough to navigate the chaos that follows when the old order dissolves and the new order has not yet formed. That is what we will continue to examine together as history unfolds according to structural logic that respects neither official narratives nor comfortable assumptions.